Right then, what's been happening with peer-to-peer lending during the COVID crisis? If you, like us, hold your investments for the long term and intend to draw an income from it in the future, then 2020 is not much different to any other year. We're seeing less interest come in than before, but it's still coming in for the most part, and it's still good.
We are investors primarily for cash flow, meaning we rely on passive income from interest, dividends and rent, so that we can be financially free from having to work a job out of necessity. It's no surprise to us as fans of the model that the peer-to-peer lending market has been so resilient during this recession, with not a single platform folding as far as we're aware. Many have responded to the crisis by temporarily cutting interest rates, halting new capital and hitting pause on the secondary markets, which has caused some people to lose faith in what is still, in our view, the best way to earn passive income from interest.
Is the stock market doing any better? We have seen companies the world over slashing dividends. A reliable source of income during normal times, stocks portfolios are weathering the same storm as peer-to-peer. The same storm, incidentally, as rental property, with tenants struggling to pay rents. The same storm as the bonds market, whose yields have been reduced to a joke along the lines of bank savings accounts, as a result of quantitative easing by central banks, and some countries cutting their interest rates to negative.
Almost every cash flow asset has been hit by this recession, but a reduced passive income is still better than having to rely solely on income from your job, the stability of which might also be looking a bit shaky right now.
In this video, we'll be assessing the peer-to-peer lending market, including updates for Ratesetter, Funding Circle, Assetz Capital, Zopa and Loanpad, and why we still think it's a good place to hold a chunk of your wealth. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Market overview. This is a difficult time for all businesses and investments. Many peer-to-peer platforms are managing the situation by putting a brake on people having a knee-jerk reaction to the current environment by pulling out their money. People forget that investing is for the long term. You're investing in loans here, it's not a savings account. Many of these loans are for 5-year terms.
Instead, we've seen platforms acting responsibly, allowing their inbuilt defences to kick in, whether that be a policy to reduce their interest rates to help halt the impact of economic change, or protecting investor capital by bolstering provision funds. The majority of peer-to-peer platforms continue to pay out decent, but somewhat reduced interest, and are taking decisive steps to weather the storm, like much of the rest of the world.
How the business and personal loan platforms adapted. Some platforms have chosen to lock down, protecting their existing investors by putting a pause on new people signing up. Platforms that have locked down include Ratesetter, LendingWorks and Funding Circle.
Ratesetter are sending out daily updates on withdrawal requests to reassure those people who panicked and demanded their cash back. Withdrawals are slow, but they are happening. According to Ratesetter, release requests increased significantly in March, peaking on 16th of March, then returned to normal levels over subsequent weeks, and actually 9 out of 10 investors continue to invest. They have delivered £55 million worth of withdrawals since the start of the outbreak, with the delay currently at 3 months.
In modern times, high interest returns are only available from peer-to-peer lending. Bank savings accounts have been a joke for some time, and quantitative easing has hammered yields in the bond markets further, to the point that bonds have joined savings accounts in clown college.
That said, Ratesetter has cut their interest rate in half to shore up the provision fund, so investors continue to not lose any of their capital.
While interest cuts are annoying, we get why it's necessary. We're just hoping, along with you guys, that it's a short-term move.
Funding Circle have also stopped new sign-ups temporarily, but have gone one step further and also put a halt to the secondary market. This means you can't sell your existing loans. You'll only be able to access the cash as the repayments come in.
Again, this doesn't really affect us because we are investors for the long term, but we get why it could be annoying to not have access to your capital. With peer-to-peer lending, you get a high rate of interest in exchange for giving your money to someone else to use for an agreed period of time. If you want guaranteed ready access to your money, you should be using a bank savings account and accept the associated joke interest rates which start with a 0 point.
Assetz Capital. Another major platform, Assetz Capital, have also had to temporarily cut their interest rate. The 90-day access account is down from 5.75% to 4.1%. They have temporarily paused lending on new loans to aid withdrawals. Other than that, they are accepting new investments still, and you are able to trade on the secondary market.
Zopa. These guys are probably doing the best of the bunch right now in the personal loans subsector of the peer-to-peer market. And frankly, they've had a good recession. Zopa was among the first peer-to-peer lending platforms, and they fought their way through the last recession in 2009. And now they are still offering 6% interest rates and taking on new customers. You can sign up to them using the link on moneyunshackled.com, and you'll also get a £50 cash bonus. Sweet.
They've impressed us by limiting the loan book to just A and B grade borrowers for the duration of the crisis, temporarily avoiding riskier C to E grade markets, and by raising the interest rate charged to those borrowers.
The property-backed platforms. Apart from Zopa, the platforms that are still taking on new customers seem to be the ones that are backed by big commercial property instead of small business assets.
We always say that you should diversify across multiple peer-to-peer platforms. Out of the 10 or so decent peer-to-peer platforms, you want to hold loans in several if you can, and from different subsectors of the market. It's sensible for times like this, when liquidity problems hit some platforms, but not others.
It seems that the peer-to-peer platforms that are having to take more extreme measures to protect investors now are the ones who lend to small businesses. Personal loans, like what Zopa provide, are doing fine, and the ones backed by commercial property have continued as normal too, maybe with a small reduction to interest rates.
Peer-to-peer platforms that are backed by UK property include Loanpad, Easy Money and Cufflink. This type of peer-to-peer platform invests in commercial mortgages and bridging loans and benefit from the protection by the value of the underlying properties.
All three platforms just mentioned continue to do well, but Loanpad stands out for its high interest rate and its innovative approach to protecting our capital.
Loanpad. These guys pay an interest rate of 4.5% and interest is paid daily. By choosing to invest in properties where they can achieve first charge security, for every £1 loan to borrowers, you get almost £4 of security from the property value. So it's almost inconceivable that material losses could be made even in extreme market conditions.
Because they have always put a focus on liquidity, they have been able to meet all withdrawal requests to date with no delays. Better yet, they are still offering customers a £50 welcome bonus when using our exclusive referral link at moneyunshackled.com.
Why peer-to-peer lending is now more important than ever. Coming out of the 2009 recession, the peer-to-peer lending industry boomed. The banks were restricting their lending, and tighter regulations meant that small businesses turned to peer-to-peer lending in order to survive and prosper. Coming out of lockdown, businesses will again turn to peer-to-peer to get back on their feet, and higher demand for credit will surely lead to better returns for investors.
And it's important that investors have choice. We need high interest in our portfolios. It is taxed differently to rent and dividends, and it is a fixed source of income.
Nothing that we've seen so far during this crisis has damaged our feelings towards the relevance of the peer-to-peer sector. We continue to view their high interest offering as a vital and welcome component of a well-diversified cash-flowing portfolio.
Question of the day: are you still liking peer-to-peer lending? Or are you in the camp that is annoyed by the slower than usual withdrawal rates when there is a genuine crisis going on? Let us know in the comments below.
Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.